Hello, chart watchers, and welcome to this Thursday, November 15th Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. You can see the Dow Jones Industrial Average has reversed off of earlier losses. We were down quite significantly, but the Dow Jones Industrial Average currently down 25 points. The S&P 500 has reversed into positive territory, up about 5 points. The NASDAQ up 42. And the Russell 2000 up nearly 9, both of those latter two aggressive indices outperforming today. 10-year Treasury yield down, but it is off the lows of the day, currently at about 3.10%. And if you recall, that is about the level where we broke out to 7-year highs back in early October. So pretty important support, I would say, from this level down to about 3%. Volatility index had shot up over 23 earlier, but it is now reversing into negative territory, currently at 21.15. The technology stocks, the XLK, leading on a relative basis, up about 1.25%. Telecommunications equipment rallying today. The reason, Cisco Systems reported their earnings results. You can see right here, up about 4% on the day, although Cisco is off its earlier highs. Consumer discretionary, definitely the laggard today. We've been in a downtrend now for the last 4 or 5 days. It is continuing, although it has rallied off its earlier lows. Home building, home construction stocks, the primary reason, down quite a bit today. And then one last negative piece of news here. Network appliance. We've seen a lot of weakness in computer hardware stocks lately, mostly because of Apple. But today, network appliance is down after its earnings report. Wasn't that bad a report. We'll go over it in a bit. But the stock has moved up quite a bit over the last few years, and it is definitely taking a break today as it drops about $8.50. Erin, Thursday, I tell you, we're only a week away from Thanksgiving. 2018 is almost gone.
I know. It's just crazy. I was telling my brother, I can't believe that Christmas is coming because I feel like I just put away the Christmas decorations. And now, it's funny when you get older, decorating for Christmas kind of loses its shine because it becomes hard work to get the tree out and get it up and all of that stuff. So,
yeah. Well, it depends on how old your kids are. I mean, I think if you got younger kids, it's worth it. But as they get older, then it's like, oh, this is just starting to turn into a little bit more of a chore.
Right. It's just for me. And honestly, little work as possible. So
you go.
Not all the decorations are coming out this year.
Now, I'm assuming that next Thursday, of course, for Thanksgiving dinner, are you joining your father, Carl?
Absolutely, I am.
Awesome.
It'll be fun. Yeah, we've been talking a lot about. I was over at the house this last week, and we were talking a lot about the FANG stocks and all of their weakness and what that could mean to the market. So we're both still cautious. I'm not optimistic yet.
I gotcha. All right. Well, we got a special guest in here joining us today. We got Julius de Kempenaer. Julius, how you doing this morning?
I'm good, Tom. Thank you very much.
Actually, it's not even morning where you are. It's probably
no. I was going to say the last few times when I was here, I could watch out of the window of my office and it was still bright light, and now it's dark. So it's 6 o'clock in the evening right here, and it's already dark for about half an hour. So there you go. Winter is coming.
You are in the Netherlands, and I'm going to show some ignorance net right now. But do you all celebrate Thanksgiving?
No, that's not a Dutch nor a European. That's a typical American holiday.
Yeah, it's the whole pilgrim thing, I guess.
Anyway. I guess so, yeah.
All right. Well, I know you got a lot to share with us today with the RRG charts as usual, and we're going to get to that probably in about 15 minutes or so. So if you would like to stick around, we'd love to hear what you got for us.
I will do that. Talk to you later.
And by the way, at the end of the show, and we'll talk about this some more, but we are going to do Are You Buying this segment? And Julius has agreed to stick around. So that should set up some lively debate on a couple key topics at the end of the show. So definitely you want to stick around for that as well. But Erin, take it away. What do we got today?
Absolutely. All right. Upcoming schedule. Tomorrow, Mary Ellen is back to do what's hot and what is not. We have my workshop, which will be on Tuesday. I've decided to do it on index analysis versus indicator analysis. So should be an interesting topic. Greg Schnell will join us on Wednesday of next week. And then, of course, because of Thanksgiving, there will be no market watchers on Thursday or Friday. All right, but today, Julius is here, and he is going to talk about using breadth on RRG. I'm really interested in seeing how that works out. We have 10 and 10 to 1. The first symbol is going to be Tesla today. And finally, as Tom was saying, we're going to have, are you buying this? And it will definitely be lively. So stick around for that. All right, Tom, take it away with technical news and headlines. I know there were a ton of economic reports.
Yeah, and you're looking at them on your screen right there. There were a bunch. I talked earlier, I guess earlier this week, how there really wasn't a whole lot, going on in terms of economic reports, but that is not the case today, as you can see on your screen. Initial jobless claims out this morning, a little bit above expectations, 216,000 versus 214. November Philadelphia Fed survey came in much weaker than expected. A little surprise there, but retail sales surprised to the upside. Came in quite a bit above expectations, both the just retail sales, and then when we strip out autos, we still see a beat there. November Empire State Manufacturing Survey came in hotter than expected, and then at 10 a.m., September business inventories came in as expected. So you kind of ball all that together, and what do we have? Well, we've got the 10-year Treasury yield down a little bit today, and I think part of it is the economic reports. I think also part of it is just simply the market being a little bit more defensive, money rotating a little bit away from equities. Earlier this morning, we saw futures, which were green most of the morning, turn red, and then the Dow opened down quite a bit. And as a result, I think money is just rotated, at least in the near term. And early on today, we saw money rotating toward defense. That has reversed somewhat today, but we are not anywhere near being done. So let's see whether or not this holds up into the close and see whether this reversal in the yield holds. Let's move on to earnings news. Even though earnings are slowing down, we did have a couple big reports last night after the bell. Cisco Systems beating the bottom line. NetEase.com, also nice strong report. Network Appliance, as I showed at the top of the show, did beat there on the bottom line, but the reaction was not very good. We'll take a look at that in just a couple minutes. Walmart reported this morning and beat, but they too dropping on their news. After the bell tonight, we've got a couple of big reports. NVIDIA coming up after the bell. Applied Materials, which has been extremely weak over the past few months. We're going to hear from them, Nordstrom's and Williams-Sonoma and some others. So earnings season isn't over, but it certainly is slowing down. We're not getting nearly as many reports, and we're not getting as many big reports for sure. Although you could see there were some big names today. All right, let's take a look at some of the charts here. First, let's start with Cisco. Here is Cisco. I think it's in a trading range. The recent high early October 49. The pullback and gap support right here down at about 43.5. We gapped up today, but we are simply sitting right in the middle of this trading range. I do like Cisco because it is part of that telecommunications equipment group. And if we pull that up, you will see that the group overall, even though it has been pulling back mostly because of Cisco, I'm going to stretch this out a little bit. I want you to take a look at the longer term chart here, because we did have a nice uptrend, sideways consolidation. We broke out negative divergence on the group. We pulled back, but now we're just sideways consolidating here. So overall, I think we still have a nice uptrend in the telecommunications equipment space. And of course, Cisco's chart looks very similar to that as well, because it is such a big component of that group. Let's move on to NetEase, NTES. And here you will see that we really struck. We got a nice response, gapped up, but I think it's pretty clear. Gap resistance is up at around 238 or so. We went above that on an intraday basis and reversed back to the downside. Now, just to kind of give you an idea of what you can expect when you see this, let's go back and do a little refresher on what happened to Canada Goose Holdings yesterday. We talked about this, where we gapped up, went above prior resistance, pulled back, closed below. And you can see after failing, we went all the way back down to about 62 on this stock after trading at 72 and change earlier in the day. So I do think it's important when you see these false breakouts, unless NetEase can recover later today and make the breakout on the close, I would expect more near-term weakness and consolidation. So just something to think about as we move forward here. Network Appliance. All right, this one has got some troubles here, because I think we're probably going to head back down to test the level around 63 63, 63.5. After making that move down, you can see, and that was a pretty big volume gap down, nice recovery, big hollow candle. Bulls probably hoping we're going to see something like that before the day is over. But after that, we did have the big rally. That was earnings news, by the way, big volume. And that started a pretty nice move to the upside. So that is what bulls are hoping for here. But we did have closing support just below $72, and we opened beneath that today. So I'm a little concerned about network appliance here, and they are in the computer hardware space, which has been struggling as a group. Walmart missed on their top line, did beat on the bottom line. They raised their fiscal year guidance, and I'm going to annotate this, but I believe after breaking out above that 100 level, it would be nice to see Walmart finish strongly today and move back up and close above 100 and leave that tail down below. I think that could signal short-term selling coming to an end. Anyway, something to think about. Let's take a look at a couple of other stocks that reported. One is VIPS. Beat on the top line, beat on the bottom line, inline guidance, made the breakout intraday off this downtrend, but failed to sustain it. Now, you can go back and look in September, pretty significant move. Here, it was a false breakout above the 20-day moving average and a pullback, and you can see what happened afterwards. This is a false breakout above price resistance and then coming back down. So I don't know. We'll see whether or not $5 holds, but for now, I think VIPS is in this 5 to 6 range. ENR, this is Energizer Holdings. Big move down. They did miss on their top line. They beat on their bottom line. They raised their earnings per share guidance. It was up earlier. Then it went down. I think the market is trying to figure out what to do here with Energizer. Some significant indecision, high near 58, low below 52, and currently at 53 and change. Very, very wide swings here today. And then Brady Corp, BRC, making a move up on the open, pulled back significantly intraday, and now trying to rally back toward the high. We missed on the top line, beat on the bottom line, 58 versus 52 cents, raised fiscal year 19 earnings per share guidance. Now, I mentioned earlier at the top of the show, the XLY, pretty weak today, moving lower, even though the market has tried to rally back. The big reason is home builders, the DJUSHB, gap down today, moving back down within striking range of that October low. Also, footwear having some issues today, not gaining their footing for sure, down about 3% on the day. And we have clearly struggled to get back up above that 20-day. We were there for a few days. We're back down below. And this one, too, has its sights set on about 1320, 1330. That's going to be a big support level. So we'll see whether or not that holds. Erin, number of upgrades, downgrades, what you got today?
All right, let's take a look. Let's see here. All right, we're going to start with the upgrades, and the first one I have for you today is Cube. CubeSmart was upgraded today by B of A from a neutral to a buy. I think this chart looks very good right now. I noted what I would call a cup, and then you can see that pullback and a handle, and now it's coming back up. It's breaking above the support or resistance at that October high. It also lines up with some of the what was support back here in the summertime. PMO is now in positive territory. Look at the OBV is rising nicely. You can see that volume moving up on the rally. That's what you want to see. And then also look at that. The 20 and 50-day EMA have looks like they're going to have a positive crossover today. So that would give us an intermediate term trend model buy signal. And you can see the 50-day EMA was able to forego a negative crossover, the 200-day EMA. If we'd gotten that negative crossover, that would have been a long-term sell, but it was able to avoid that and head back up, and I find that especially bullish right now. So on the upgrade, I think CubeSmart looks pretty good. Kimco, KIM, Evercore upgraded it from an underperform to inline. I don't think investors were too impressed with this upgrade. I wouldn't have been either when I looked at this chart. We've got, even yesterday, you can see that price fell below that 20-day EMA. which caused, excuse me, it caused the 50-day EMA and the 20, of course, to bow over and basically miss out on buy signals. And now we're heading even lower. I know some people might look at this and they're what looks like a double top. I wouldn't go with that just because typically it's a reversal pattern. We just went up into it. I don't know. In any case, I just think this doesn't look good. I would still expect that breakdown, but I would be looking rather than a target, the length of this pattern. I'm just looking for that 1450 area. PMO is topped, still in positive territory, but doesn't look like it wants to stay there. So I'm not really thrilled with Kimco Realty. Mylan was upgraded today by Argus from a hold into a buy. This one I'm not really impressed with either. We had the breakdown yesterday. We are seeing a bit of a rebound here above the 20-day EMA, and the PMO is now in positive territory, so there's possibility here, but there's also a very large gap here that I'm thinking now that we've started coming down that there's a good chance we'll close that gap. So I would be a little bit leery, I guess. Could end up, just stopping right about here at that previous top in November. But that one's a little bit iffy. Realty Income Corp upgraded by B of A from a neutral to a buy. I think this chart looks great. I decided to put it on a weekly chart to show you. $65 seems to be the place. That's the highest close that it had back in 2016. Looks like it's certainly ready to head up there and surpass that high. You've got the PMO bottoming above the signal line and rising nicely on a weekly chart. So that tells you that there's intermediate term, longer term momentum going on here. All right, Blue Apron. Let's move to some downgrades today. Blue Apron, pretty darn ugly. This one has, it's a meal kit provider. But it's surrendered 88% of their value since going public like last summer or 2 summers ago. So this one is really struggling. That particular area of the market is, the competition is really heated up there. No pun intended. And so, I'm looking at this $1 level. I think that's where certainly it needs to make that turnaround, but it did have another bad report. So 2 agencies, Guggenheim and Canaccord Genuity, both downgraded it. They only downgraded it from a buy to a neutral or a hold. I would not be holding this. Price target lowered from $6 to $3 is what Canaccord's looking for. I think they'll be really lucky if they could get back up to those heights. I just don't see it. You could see it on the weekly chart too, pretty darn ugly. Yeah, so it's just been in a free fall. It did make that move back earlier in the year during this summer to make a move back up to the $4 level. But since then, it's just been a huge slide to the downside. Final downgrade for you, Cabot Oil and Gas. This one was downgraded by Tudor Pickering from a buy to a hold. This chart, I think, there could be some promise here. The only problem I have with it really is this PMO that's trying to top in overbought territory. It appears to be overbought territory, but I did a peek here. And I believe that the range is a little bit, yes, we can see that the range of the PMO typically, I would say, is between 5 and -5. I think that kind of incorporates most of those tops and bottoms. So really, 3.32 reading isn't that overbought after all. All right, and you can see here on the chart, we have support right here, a very strong support, I'd say, with these tops right over here. And I did make it down to the highest it was in those 3 of those tops. And it's coming right down there. It also lines up with gap support. So there's certainly a possibility that we'll get that bounce off of that 2450. And if we do, I think this one could be a pretty good buy. I mean, look at 50 just crossed above the 200, yet it's getting downgraded. So might be interesting for a watch list. That's all I have for upgrades and downgrades. And here is a summary of what I just looked at. So I covered the ones I covered, but there were some other upgrades. Cody, Voyager, which is a healthcare, and Oasis, another oil and gas. And then, of course, PCG. That was downgraded yesterday. This is the PG&E that's in trouble right now in California for possibly causing some of those big fires. So they're under investigation. That one is, I don't see that recovering anytime soon. And KB Homes was also downgraded. All right, Julius, I've been yakking long enough here. I think it's time to bring you in so you can show us some RRG with breadth. I think.
That was let me grab the screen. That's a little bit of an experiment that I'm playing around with, and I just wanted to share with you guys. I just literally 15 seconds ago decided to swap my segment around because I wanted to start with an overview of the markets using RRG and then talk about the breadth stuff. But let's start with that right away. So we can get it out of the way and then see how far we get with the overview of the markets using RRG, because usually that takes a lot longer than in real life than it takes in my mind, which makes that we always run out of time in the end. I quickly, I saw in the poll that there is still quite a lot of people who are not using RRG. So we were joking before the show that everybody who voted not using RRG would be kicked off the channel immediately. We decided not to do that. So, but what I want to do is point out a couple of areas where you can find stuff about RRG. Today, mostly on Thursdays, I write a piece on Don't Ignore This Chart. 9 times out of 10, it will be about an RRG that I think is interesting. So you can find something about RRGs there. And the main blog is the RRG charts blog, where I write, let's say, between 3 and 5 articles a month. They are pretty much always on actual markets, and very often I try to blend in some educational or rationale or explanation for the RRG stuff. So after today, you can be on the lookout for a blog article that talks about using breadth indicators on RRG, which you will have the primer for today. What I want to talk to you about is breadth. Now, the breadth stuff is something that's coming along very often. A lot of people talk about breadth. And I was triggered very recently by an article by Arthur Hill, who picked up on a couple of indicators that are used on the stock charts database that measure the percentage of stocks above their 20-day EMA or the 200-day EMA. So these are real breadth indicators. Now, the good news is that we do have them for all these individual sectors, which is where I come in a lot of times. Now, these are the tickers that start with exclamation mark GT. 200 is for the 200-day EMA, 50 is for the 50-day EMA, etc. And when I was preparing for this, I immediately had to think about Greg Morris, because a lot of the times I remember Greg Morris as someone who is very big on breadth stuff. He wrote a book on breadth stuff that's, I think, in the stock chart store available. And I remembered one of his sayings in one of his presentations, that says that breadth arrives at the party on time, but always leaves early. And I didn't exactly know how the wording was, so I had to look it up. And then I ran into, I didn't have to look far, because actually Greg wrote an article on breadth stuff not too long ago, November 1st. And I found out that the quote that I thought was Greg Morris's is actually one by Tom McClellan. So it says here that Tom McClellan says that breadth arrives at the party on time, but always leaves early. And being from a military background, I like the analogy that the troops are no longer following the generals. So I think you get the picture about what breadth is actually doing. Now, in general terms, we always look at breadth from a broad market perspective. So we look at advanced decline lines, at number of stocks above EMAs, volume, etc., etc. But that's always looking at the complete market. So AD line for NYSE or AD line for the S&P 500. Not a lot of work has been done on sectors. So when I read this stuff, I always try to find ways to blend it in with my own work on RRG. And a while ago, I had already been playing around with bullish percentage numbers on RRGs. I've set up this RRG quite a while ago. I played around with it a while. Didn't find any, super strong relationships, and went away. You know how it is when you do research. You look at it, you play around with it, and if it doesn't immediately work, you just park it somewhere, and then you get back every time over time to actually see if you can find something better or improve it, or you see something that you didn't see before. So I had this on my screen for a while already, and then I ran into Arthur Hill's article where he pointed me to the GT 200 and GT 50 in the indexes, so to say. And this is actually another use of relative rotation graphs, where you may be normally using RRGs, using asset allocations or the predefined groups as we have them here, or you have your own setup. You can perfectly use it for derived indicators like the bullish percentage numbers or the other ones that I'm going to show you in a minute. The big issue that you have to be aware of is that just like with sectors and stocks and basically anything you want to throw at an RRG, you have to make sure that you're comparing apples and apples and oranges and oranges. So for the bullish percentage numbers, these are the ticker symbols that are in the database. But there is also one for the S&P 500. So if you do this, make sure that you run all the sector numbers and you compare it to a similar number for the overall market. So here we are using all the bullish percentage numbers of the individual sectors, and we compare it to the bullish percentage numbers of the S&P 500. This makes it a comparable universe. And you can see that if we scroll through time, we see the normal rotation that we always see on an RRG. Now, taking the general assumption for breadth, the idea here is that these bullish percentage numbers, or the other ones that I'm going to run by you in a minute, will, well, at least give us a little bit of a heads up or an early warning signal, or maybe a little bit of a different angle of what's going on under the hood of the engine being the general market. Now, if we look at the situation at the moment for these bullish percentage numbers, this is, yeah, I'm here right at the end. We can see that the utilities are right up there in the leading quadrant together with staples. And I am going to actually create another chart quickly side by side for the S&P 500, or let's do SPY, so that we can actually look at that. This is when you change your stuff. I want to do an RRG for the sectors, and we're going to put that on the right-hand side, and we're going to put that bullish percent stuff on the left-hand side. So now here we have basically the same group. So we've got the bullish percentage numbers on the left-hand side, and we've got the general ETF and the 30% that's not using RRGs. Go to the RRG page and select that drop-down and check it out, because that's probably the most used RRG, well, I can say in the world, actually. So let's put them side by side. So staples here, and we can put staples here as well. Now, the big trick would be to find out when this starts to move around. You see that it actually started to improve, entering, and then the right-hand side moves. So this is where staples actually started to move over. That's August 10. Now let's see where this happened. The staples ETF was well inside the improving quadrant on August 10. It was good. It was looking strong, but it wasn't in the leading quadrant yet. But the staples bullish percent was already crossing over. So this was an early warning signal that staples was actually improving, not only in terms of price relative strength, but also in terms of breadth of the bullish percent. We can do a similar exercise here with healthcare. And look at that. And we see that on August 10, they crossed over. This was probably a little bit more. Look at this. All on the right-hand side is positive, people. So this actually crossed over here January of 2018 already. Let's see where the healthcare sector was at that time. It was probably somewhere in way down in here. So it started to improve. And if we see healthcare here, was under the hood. It stayed on the right-hand side. So the bullish percentage of all the stocks in the healthcare sector stayed on the right-hand side. And we're here now on June 22nd. Let's see what this happens. February, March, one rotation lower, picking up. June 22nd, still there. Healthcare, bullish percent starts to improve, starts to take off August 3rd. August 3rd, we really start to cross over August 10. And then we continue on the right-hand side and continue to rotate. And now we just crossed over here to weakening and in lagging on the bullish percentage numbers. And what you see here is that healthcare has started to roll over. So I'm now very interested to see if this weakness in bullish percent has been leading. It looks at it right now. I'm not seriously 100% convinced yet, but it looks like it's leading the way lower for healthcare here. Let's quickly move on to another setup, which is the one that
Hey, Julius.
Yes, Tom.
Before you leave that page,
yes,
I just wanted to mention I looked up the XLV just to get the top holdings, and about 30% of it, about 30% of the XLV is Johnson & Johnson, Pfizer, United Health, and Merck.
Right.
So 4 companies that are in the XLV, whereas when you're showing the bullish percent index, you're talking about all of those companies in healthcare.
Yes.
And evenly weighted too, correct?
Yes.
There's no weighting.
Yes, there's no weighting there. It's just bullish percent, the number of X's in a point and figure chart. This is the definition.
Yeah, this is a pretty interesting exercise. It would be, and I know you said before the show that this is kind of an experiment. You're kind of going through and trying some things.
Yeah.
But this would be interesting to go back and plot. And when they start to give signals, if you actually started to reallocate, what I'm doing for you is giving you a homework assignment.
Thank you. I'll add it to the list.
Yeah, I mean, as you're getting that cross, and I don't know if it's that center horizontal line where if it goes from left to right, then you overweight that sector in anticipation.
Yeah, that's a debatable thing. I tend to look at it from a high level perspective. So I try to see if they're improving or deteriorating. And the way I look at this, let me zoom in here for that healthcare move. So I would see like this. I would see as a deterioration for the healthcare sector, not necessarily a quote unquote signal, but more like, hey guys, something's happening under the hood here. So this is August 31. Healthcare bullish percent numbers are dropping. So they're turning around, they're rolling over. Late August, early September. So if I go to late August, early September here, then on the ETF RRG, everything looks very strong. The sector is doing very strong. But on the left-hand side, it looks that under the hood something's cooking. And I would actually, you're absolutely right. I would have to dive in, to do a deep dive into the sector, because right now, following your remark, I wouldn't be surprised that it is those large cap stocks that are carrying that index higher, where the rest of that universe, which probably is a lot smaller market cap stocks, are already going to negative bullish percent numbers, or going off their bullish percent, already dropping here, which leads that rollover in XLV that we've seen over the last 1, 2, 3, 4, 5, 6, 7 weeks, maybe. Mind you, this is still one of the stronger sectors, so this is not a super sell signal, but it's just sort of an early warning signal that the run may be over, or the run might go into a temporary pause, which probably is more likely given the high reading of healthcare on the RS ratio chart. Yeah, so very good point. Let's go to another one which has a similar background. That is the number of stocks above, and let's start with the long-term stuff. Let's start with the 200-day moving average. So what we're looking at here is an RRG broken down by sectors of the number of stocks that are above their 200-day moving average. In terms of a percentage, so it's comparable across the universe. So the number of stocks in the sector doesn't influence it too much. Although I have to say that I was chatting with Arthur Hill about this morning, our time, when all you guys were sleeping, on using this, because I wanted to get some feedback from one of our fellow commentators who does a lot of work in sectors, and we came to the conclusion that although it is a percentage number, so it is comparable across the universe, it is kind of dangerous when the sector is too small. And right now, from a high-level sector perspective, so the 11 S&P sectors as we have them right now, they're all pretty well filled. They're all 20, 30, 40 names in them. So that percentage number would be a reliable number. The discussion that we had was on the new communication services sector, where it would be an issue, because previously that sector held only like 3 stocks. So if one stock flips, that percentage changes big time. So that's why you will not see the XLC in this list for that particular reason. And we're working behind the scenes to work out a way how we can, like we did with the history for XLC, maybe also come up with an idea on get those numbers correct for a sector like XLC. So if we go back to the actual market here, and I see that this is daily, so let's switch that to weekly so we can compare that with the weekly RRG there. Put this slightly lower, make it more visible. There you go. Now, again, you see that this is also, showing you a rotation as you would normally see on the standard RRG settings. So I was quite thrilled when I saw this, because it gives me another tool, another way of using RRG and get a different angle on what's going on in the markets. Pay attention here that just like with the bullish percentage numbers, we have the GT200 series for all the sectors, and we compare it to the GT200 for the S&P 500. So again, apples and apples, oranges and oranges. Now, where are we at the moment for this? Let's go to the utilities. Are showing a very strong move here. It went through a rotation from leading through weakening back into leading, and as we all know, utilities have been doing very, very strong here recently. Now, let's say that started to cross over somewhere in July. Now this people is just as big a surprise for you as it is for me to see where this is coming out. So let's see, all the way back. Whoa. Wow. There you go. So crossing on, I don't like the fact that it's dropping off immediately, but it was already in May. So look at this. This is July, and in here in May, we already had the number of stocks crossing over that 200-day moving average, and then it dropped off a little bit, but stayed on the right-hand side. So, you know, this means that it's still going up, but it's losing a little bit of its pace. It's losing a little bit of its momentum. So the trend is still good, but it's more shallow and it starts to move up. So if we stay here, that's no problem. One rotation through weakening, going back up here. And it's actually just going back up. So it looks as if it's starting a new up lag in that relative uptrend. So you know, from this assumption that this breadth setup is leading the market, you know, utilities are still, you know, one of the stronger sectors. And this is staples. Let's see what's happening here. This is August moving over. Still on the right-hand side. A short tail means that the number is stable, that it's an uptrend. It's not picking up in speed, but it's also not losing speed. So it's a very stable move. So if we put that on staples here, then, you know, that is staples crossed over, what was that? October 19. If we go here, this happened August. So this is just, you know, back of a napkin type analysis stuff that I wanted to share with you guys. But I hope that I can confirm, and I need to do a little bit more work on this, that when you throw a bunch of breadth indicators that are a closed universe of the S&P 500, that we can actually get an extra handle on the rotation of the sectors itself. So stay tuned, and I will try to keep you updated on that. Quickly go to another setup, which is similar, but goes to let's say the EMA 50. This is obviously gives you faster signals because it's only the 50-day moving average, exponential moving average that it's looking at. But the rotational pattern, as we've seen it before, is the same, and you can look at it. Now, one other exercise that I played around with this afternoon actually was, let's stick with XLB. There. Got rid of that because you can also do not only the 50, and here we change that to 20, and here we do the 200. So now we've got the 50-day, the 20-day, and the 200-day, all for the materials sector. And this is where I started to struggle a little bit because, you know, you can see this here, and we're comparing it to the 50-day moving average of the S&P 500. So, you know, that's kind of weird because I was telling you, you got to do apples and apples and oranges, but what's the apple for the benchmark here? So I was playing around with it. I didn't really figure out. So I thought, you know, let's just compare it to the $1 symbol, which means that it's there. You're only looking at it from the perspective of the benchmark there, and you're comparing it to an absolute number. And this is where you start to. Let's see here. So we got the 20-day improving, we got the 50-day next, and 200 there. So 200 is weak, 20 is stronger, and 50 is in the middle. Leads me to believe, but again, this is very, very preliminary, that the materials sector, the number of stocks in the materials sector above its 200-day moving average is weakening. It's improving for the 20-day and slightly less for the 50-day. So this is a big downtrend for materials with a little hiccup. It's moving a little bit higher. And let's get the materials here. Okay, that's weak. That's for sure. That's why the 200-day is there. That's why this one is there. And I suspect that this improvement here is this little hiccup that we saw not too long ago. So it's the oh well, it wasn't there. So this little hiccup here is this move in the 20-day is causing this little hiccup here. But materials right now, just where we were on the right-hand side, where healthcare is still the strongest, materials, despite this little hiccup, is still the weakest. And this is sort of confirming it because, the long-term moving average, the 200-day moving average, more stocks are below the 200 moving average than above it. And the number of stocks above its 20-day moving average is improving. And that's exactly what you see here. Let me wrap this up here because I'm running out of time if I want to give you a quick overview of my view of the state of the markets. But I thought this was super cool to share with you because it's a completely different way of looking at RRGs. And basically showing you that you can use this tool for a lot more than just looking at sectors. And that brings me totally fine to my next item, which is where I want to share with you the state of the asset allocation. So this is a predefined group. If you go to groups in the drop down, you will find the predefined group asset allocation next to a bunch of other predefined groups. This is the sector ETFs, and these are all the individual stocks for the individual sectors. The big takeaway for me on this RRG is the fact that we got this whole cluster here of fixed income related markets and the US dollar that is improving. And we've got the equity market, the S&P 500, which was the leader for a long time, is now seriously starting to weaken. So for me, this is my first risk-off signal. This is signaling risk-off for a while already. I mean, I think that exactly a month ago, the title of my talk in Market Watchers Live was "How many red flags do you need?" And let's go back. It was like 4 or 5 weeks ago, probably October 19 here. You saw that S&P, Spider were already rolling over and fixed income was improving. Now that rotation has continued and it's still continuing now. So that risk-off signal is still being sent to us by the market. Now, the big exception is commodities, DJP. If you look at that individual chart, I'm still not very super happy about that chart, but that's the whole thing about relative strength. If everything else is starting to decline, even if you're stable, you start showing up as a leader, and that's probably what's going to happen with commodities. So this asset allocation RRG gives me a risk-off signal. If we then bring that to our sectors, if we go to the S&P 500 sectors, then that leading quadrant is still populated by what's commonly known as defensive sectors. So we got staples here, we got utilities, and we got healthcare as the strongest one, rolling over a little bit. Healthcare has a very short tail, which means that it's very stable. There is, it's on the right-hand side. It's got the highest RS ratio reading, loses a little bit of momentum, nothing to worry about yet. And we've got staples and utilities basically still powering higher into that leading quadrant with long tails. Look at these long green tails. Compare that to the rest of the sectors on this chart. So that's the first takeaway, that the defensive sectors here are still leading. And then there are two other sectors that are catching my eye, and they're almost overlaying, and these are technology and discretionary. So here's technology, and right below it is discretionary. They're almost moving in tandem. And these are the sectors that have let's say the most downside relative potential. Why is that? Because communication services, energy, materials, they're inside the lagging quadrant for a long time already. These sectors crossed over. Well, let's go back here. This already happened. This is September, mid-September, those crossed over, and they're inside lagging and continued lower from mid-September. Is almost, good month and a half. And now we see XLK and XLY moving over, and they're joining these sectors inside the lagging quadrant. So these are the more offensive sectors, as you will. So, this sector picture, again, sends me a risk-off message for the market as a whole. Now, let me wrap this up. I think I'm doing quite good on time, actually, with a chart of the S&P 500, because that's where it all leads to. That also gives me the opportunity to answer a question that I picked up just before I started my segment. And the question was, how do you use or read the RRG relative strength indicator on a sharp chart? So here it is. This is the setting of the RRG on asset allocation. So now we've got two things side by side. This clearly is the S&P 500. You all know it. Here we see SPY versus, I always use VBINX. That's a Vanguard balanced index fund that consists of 60% equities and 40% fixed income markets. It's not only government bonds, it's a mix of fixed income markets. There are also high yield and corporate bonds in there. So it's a typical balanced portfolio. What we then do is we compare all these asset classes, these asset class ETFs on the chart with that VBINX balanced index portfolio. And this is what I call raw relative strength of, in this case, SPY versus VBINX. And this is the RRG relative strength indicator plotted on a sharp chart with relative strength looking against VBINX. And what you're looking at here are basically the two indicators that are plotted on the RRG. So the red line here, the RS ratio line, is what you see on the horizontal axis of the RRG chart. And the green RS momentum line is what you see on the vertical axis of the RRG chart on the left. Now, if we go here, and this is all update, to the last. So what you see is that RS ratio is at 172 for SPY, and RS momentum is at 99.44 for SPY, which positions it exactly here. So this is 172, and you can see this is just below 101, and 99.44. You can zoom it in, and then it probably makes it a little bit more clear. You can see just below 99.50, just below 101. So this is where SPY is positioned on the RRG, and this is how you connect it back to a normal chart. So when the red RS ratio line is above 100 and the green is also above 100, you're inside the leading quadrant. If the green line is below 100 but the red is still above, like what we have for SPY right now, we're in the weakening quadrant. If this move continues and the red line drops below 100, then we move into the lagging quadrant. And then we get a situation where, let me get this here, where the red line and the green line are below it, you're in lagging. And if the green line moves above 100 and red is still below it, we're in improving. And then you got your whole rotation going around. So for the S&P 500, I think that we're losing relative strength. That's very, very clear on an asset allocation level. So risk off all the way. I think that we have a new lower high in place here, just above 280. That's last week. And we're coming down now. So the level that I'm watching, and it's still the same level that I was watching last month on the same segment. If we zoom into the daily, we got a little bit better here. That's around 260. I think that 260 low, and that has nothing to do with relative strength or RRG or any type. It's just plain vanilla technical analysis. If we take out that 260 low on the S&P 500, given that longer term picture, I think the market is in even bigger trouble than it is already right now. So that risk off stance, seriously, I would continue to look at that. Can I have 2 more minutes, Tom, or are we?
We're getting pretty close, and I do want.
Yeah. Okay. Yeah. Go ahead. No worries.
I want to get that poll up and see what everyone does with RRG, because first of all, I think you've shown here over the last 30 minutes or so how important this is and should be in everyone's trading arsenal or investing arsenal. There isn't necessarily just short-term indications. I mean, you're showing over periods of time how this money is rotating. But I got a question for you based on everything that you've said, and with money rotating into defense, but still not yet losing support levels. And that question is, what do you do in your own investing when you are nervous about the market? You haven't lost key support levels that you're watching, but you're seeing money rotate. Are you personally getting more defensive with your investments, moving into more defensive areas? Do you move into cash more? Can you give everybody maybe an insight into what you...
I am not a trader. I use a little bit longer term time frame. I am moving money out of equities for a while. So where I would hold like SPY or the equivalent for European markets, because I'm a euro denominated investor. So I trade like the stocks indexes or the DAX or whatever. If it comes to equities, I would take money out of equity markets. And put it. I used to basically switch as a core of my portfolio between equities and bonds, and I would switch between the equivalent of SPY and IEF for the European markets. But with bond yields so low and those bond markets so high with so much risk, I am quite scared about moving money to longer term bonds. So I started using shorter term duration. So I still move to lower risk, but I think that long duration bonds are still very risky or can be very risky. So I over the past 2-3 years, instead of equities, I started using to use shorter term dated bond ETFs rather than bond futures.
Okay, awesome. One shocking thing I see here in the poll is that 35% of you are not using RRG. That, I think, based on this presentation, probably should be changing.
Got to change. Guys, if you're not using it and you for whatever reason, you know what? I have an idea. Everybody gets the question when we leave the show, what you think. If you, the 35% of the people that are not using RRGs, I would be super interested to hear in that poll why you are not using it. It can be, I don't like it, I don't know how to use it, I don't understand it, or whatever the reason is. And I'll try to get back to that because I think that's a very interesting exercise.
Yeah, and I think like anything else, if something's new, it's hard to adopt. You know, it's hard.
100%. Yeah, I don't blame anyone for not using RRG, by the way. I don't take it personal at all.
Yeah.
So don't worry.
I want to point out that you do have a blog, and if they're not familiar with it, they should be reading your blog, because in that you have a lot of very educational content on how you can use the RRG.
Yep, and my email address is underneath that. So I monitor Discuss, and when Discuss is closed, I'm very happy to take emails. No problem at all.
All right, and I just want to remind everybody that in order to fill out responses, you need to write that in the survey that's below your video player. So I know Julius would love to hear from you, especially after that presentation. And I got to tell you, Julius, there were times when you're doing the apple and the apple and the orange and the orange, everything really made a lot of sense. You know, and maybe looking at the bullish percent as possible precursor to some weakness in ETFs. The last one I got to think about for a bit, the 20.
Yeah, sure. I've got to think about it. But I like that. It's fun. It's out of the box. I have often when I throw this at an RRG, it's like, what the hell am I looking at? You know, so seriously, you know, it's a Pandora's box for me. Every time something new comes out, and I got to think about what it actually is and whether it makes sense or not.
All right. Well, we're going to move on to the 10 and 10, but I do want to remind everybody, Julius is going to stick around with us. We're going to have an "Are You Buying This" segment, which is basically a little mini debate. And I think it's going to be really entertaining. So stick around for that. But Erin, if you're ready, let's jump into the 10 and 10.
Absolutely. Let's get right to it. I did want to mention that we had a huge amount of consumer discretionary. We had 7 retailers that people wanted to look at. So we'll probably be looking at a few retailers, but let's go ahead and start with Tesla.
All right. This is going to be record time today, I promise. Tesla, I think number one, nice volume coming in on this most recent uptrend, but we are still moving sideways over the last 6 months. If this truly is the beginning of a trend, we should watch this area of support between 320 and 330. Rising 20-day currently is at 328. This is going to be important on any pullback.
All righty. The most popular in the chat room, interestingly enough, Healthcare Spider XLV.
Yeah, well, I think Julius certainly just talked about that quite a bit. I would just say this. I do see a continuation pattern here. I know Erin doesn't follow the inverse head and shoulders. Maybe others don't as well, but I do. And so let me just show you off of this uptrend. I think this could be a continuation pattern with a neckline there, left shoulder over here, right shoulder potentially going in, and that inverse head in between off of this uptrend. If we break that neckline to the upside, I think that would be very bullish. To the downside, obviously, you don't want to take out these lows to the downside. So let's drop in a little bit of support right in here. So those are the areas that I would watch on the XLV. I still have a bullish bias to the market. I believe this is a correction. So I would be a buyer on weakness in the XLV, but again, that's just me.
All right. Next one up. We haven't looked at it in a week, believe it or not. Amazon.
Wow, Amazon.
I know. Well, we haven't looked at it in the 10 and 10.
Yeah, it's definitely weak. And I mean, one of the things when a stock is trending nicely to the upside, you see it for the most part trading above its 20 and the 20 above the 50. We have the reverse configuration right now, and that's not unusual during a correction, but it needs to reverse. So I would be watching a couple of things here on Amazon. Number one, I think the low, that was a lot of volume. I think that was a capitulatory low at the end of October. That needs to hold. That's just a little bit below 1,500. To the upside, I think this reaction high back to 1750, which went temporarily above the 20-day, that's key resistance. I think that's your trading range for now.
All right. Up next, I think Bruce talked about it yesterday, FireEye, F-E-Y-E.
Yeah, this is one I believe that's also on my strong earnings chart list. I believe they beat Wall Street estimates. Actually, I love this pullback down to price support and very close to the top of gap support. So I think today was a buy signal on FireEye. There's your pretty much your prior highs coming across here. You gap up, very heavy volume, trade higher. You come back to the top of the gap support and then reverse holding on 20 days. So far, I think this is bullish.
All right. Next up, U.S. Silica Holdings, SLCA.
All right. Continuing downtrend. I'm going to stretch this just a little bit longer. Go back a year here. Yeah, definitely a clear downtrend. And we went back up, filled a gap. So I'll show you that. I mean, we've got to at least get through that gap resistance before I would even begin to think that the chart's been repaired. We have a double bottom in play. We have that gap resistance just below 16. We tested it earlier, now moving back. Lighter volume on that move up. I'm not convinced yet, but it's starting to show signs. A close over 16 is what I would look for here.
All right. And this one was a high request, and I know it's in the ticker cloud. The Brazilian iShares ETF, EWZ.
All right, just remember all of these ETFs that track these foreign indices are subject to the dollar. And the dollar's been very strong, so it's going to cut into some of your return on these ETFs. I'm a fan of the dollar. I think the dollar is going to go higher in time later this year into 2019. So I think that investing in the U.S. is better, but I'm going to go ahead and draw in here the current trading range that I would watch on EWZ. A breakout above 42, obviously bullish. To the downside, you don't want to lose the 37.5 level. On the most recent high, we do have a negative divergence in play. So I think there could be a little bit more weakness down the road here in EWZ.
Okay. Next up, our viewer asked, can you get on board with Carnival Corp, CCL?
All right, I like the pun. I'm going to get on board with the pun. I don't know that I'm going to get on board with the stock, though. We did have a nice little run there in September, and I think this group tends to do well in September. And then it completely fell apart, went back down below the 20. I think in the short term, we've got this nice little uptrend in play. So, if you're on board, I think probably given that the fact that we have a downtrend in play, if we can't hold the 20-day, we did it a few days ago, but if we pull back again and we can't hold that 20-day, I think you have to recognize that the longer term trend here is lower. So I'd be careful with it.
Okay. Let's see. Next one, Costco. I'm making a trip there today, in fact.
I need to make a trip there. Let's see. Costco. Holding up pretty well. I mean, obviously this week has been a rough week for Costco, but it's been a rough week for a lot of stocks. I think after the uptrend, we set a pretty important low, double bottom here. So I would annotate that. I want to hold those lows to the downside right in here. You might even go a little bit further back to this other low here. We gapped down and then rallied off of it. Somewhere 215, 217, I would watch. Top side 245. Again, I believe the market goes higher in time. So I like Costco, but I like it a lot better if it gets closer to the support level.
Okay. The only industrial requested, Caterpillar, CAT.
All right, Caterpillar. Another one downtrending. We had a nice move here, for a while, but we've come back below the 20 and we've been struggling to get above the 20. So in the short term, this is another one that I think is just making me a little nervous. Right here, after breaking back below that 20, you can see these failures with these tails just slightly above the 20-day moving average. So until we can get a close, if we could get a close back up above 130, especially above 135, because that was that pretty significant reaction high right here off of this downtrend. So if we could get back through 135, I definitely would begin to be more bullish. But I'd like to see some more volume coming in on the buying as well.
Okay, and the last one, let's do Apache, APA.
All right, Apache. Well, first of all, energy stocks, oil stocks really been getting hit. You can see that has taken a toll here on Apache. We did have a slight breakout above that 49 level. So if we go back and we take a look at these prior highs right there, and then again right there, you can see that we had this false breakout and then came back down. I would have expected it to hold the double bottom support just above 41. It didn't. It kept going lower. Volume has picked up. There's one positive here that I'm going to go ahead and end on, and that is that in the near term, we have a positive divergence. With these lower closes right through here, you can see that the PPO is turning back up. I find that to be somewhat bullish. I think we could have a run. If we get through the 20, we're going to make a run for the 50, which also would probably coincide now with this price resistance. So let's see if we can continue to hold on to the recent lows. If so, I would look for a target maybe up around 40 to 41.
All right. Excellent. Well, that completes the 10 and 10. Here are the symbols that we just went over. They will be in the Market Watchers Live chart list. You'll find that at the top of the Market Watchers Live blog. Just go to the blogs tab and you'll find it there. All right, time for our final market update, and then we're going to get into that exciting segment. Are you buying this? So stick around. All right, interesting look on the market, I would say right now. Here we go. All right, so you can see declining trends are still in place. We did try to make a comeback, though, to the positive for the Dow and the S&P 500. And the S&P actually hit some positive territory, but it is now declining again. It is currently down about 0.25%. The NASDAQ actually faring probably the best of all of them because, number one, it's still in positive territory. And it's spent most of the afternoon there. So we're seeing right now it is starting to head back down. Currently, we're getting a reading. It's up 0.14%. S&P 400 also lower. Mid caps has spent some time in positive territory, but appear to be back down in negative. And the Russell 2000, although in positive territory, is very close to getting back into those negative readings. TSX, Canadian markets, have spent most of the day on the downside, getting ready to test an intraday low, currently down 53.20. The Treasury yields are lower today, reading 3.092%. UUP, big gap up, but moving sideways at this point, but still up 7 cents. Gold, not doing that much, except that it is staying on the positive side of things. It is up, GLD is up 12 cents to 114.76. TLT bonds are higher. They did make a move toward negative territory, but bounced off yesterday's close, up 28 cents. And USO started the day up quite a bit. It has fallen back down, but it is still up 0.42%. Currently, USO is right at the $12 mark. And that's all I have for the final market update. I'm going to pass it to you, Tom.
All right. Got one chart I want to show real quick, and then we're going to get into, are you buying this? This is a chart of the S&P. And on this chart, you can see, first of all, we had that gap up back at the end of October. We tested the top of gap support, then we kept moving higher, came back down, tried to hold around that 2,700, bounced, and then back down we went. Now we have gone down and we have filled the bottom of this gap support. And part of the problem, and I've been writing about this, is when you go below that 20-hour EMA, you can see when you're in these short-term downtrends how difficult it is. We saw this back in October as well, how difficult it is to sustain a move through that 20-hour EMA. So we're not there yet. The one good thing I would say is that once we got through some initial selling and we went maybe a little bit lower, but you could see the PPO starting to flatten out. And on this final drop, you can see that the PPO had already actually started to turn higher on the lows. I think that's kind of what we're seeing right now. I would be watching 2680. I think if we lose that on a closing basis, that will begin to set up what I think could be a very, very significant test of the October low and possibly even that February low on the S&P. We never closed below 2582, and you can see we're not getting close, or we're not getting far from that 2580 level if we go back down to those October lows. So with that, let's go ahead and move over into, are you buying this? Erin, I figure, why don't you go ahead and start this?
Okay.
And just to let everybody know what we're going to do, Erin is going to make an argument for about 2 or 3 minutes. And then Julius and I will each have a 1-minute rebuttal where we will either say we are buying it or we're not, and we'll give our arguments. And then we'll switch. Julius will go second. Erin and I will respond, and then I'll come up with my topic, and Julius and Erin can respond. So go ahead, Erin. What do you have?
All right. I think that we are not out of the woods for a bear market. I think the bear market is still in play. And here is why I believe so. So first of all, here are the decision point scoreboards. And you'll notice that we are seeing green, obviously, in the longer term. But when you look at these charts, these monthly charts, you're going to see that we're in a lot of trouble here. So I want to just go and show you first these PMO buy signals that are right there in the short term. They're about ready to go. They're not going to be here very much longer. So that is something that I'm concerned about in the shorter term. But what I really want to show you are these monthly charts. And if you want to know more about these, I did write about them yesterday. Here's what bothers me right now is I'm getting these long-term PMO sell signals that are likely going to come in at the end of the month because these aren't final until the end of the month. I don't log them then, but you can see that we're getting ready to have another sell signal. Typically, these sell signals are on the mark. So that is what worries me. We're getting ready to have another one. Now, maybe best case, we just stay in the big wide trading range, but boy, it looks a lot like what we saw back here in 07, 08. So that would be my problem with it. And you can see pretty much all of the monthly charts are looking the same way. So that is what my concern is. I think a bear market is still in play. So I'm curious what your thoughts are. Do you think a bear market is still in play? And here's another one. This is the S&P 500 monthly chart. And there you go, another monthly PMO sell signal. And again, I've marked where they typically come in. And you can see that these are buy signals right here that came in. But the red ones are sell signals. They do not come in often. They really don't. And we're getting ready to have them. So I'm just saying.
All right. Great. Julius, I'm going to let you go first. You got a minute. Do you agree with Erin's assessment that we're not out of the woods and we could be in a bear market?
Do I need to talk a whole minute to agree?
No. You
can say, yes, I'm buying it.
There you go.
And I'll tell you in my segment why. No, I agree. There is nothing. Yeah, I don't have anything. Well, I will add a little bit and I'll take it from my angle. But yes, I do agree. I'm buying this.
Yeah.
Okay. The way that you worded it, Erin, I figured when when you started talking about bear market, I'm thinking, okay, I'm taking the other side. But you said, are we buying that we are not out of the woods? And I definitely would agree with you. We are not out of the woods. I don't see anything yet that would confirm that the worst is behind us. So,
all right. So you're still online for a possible bear market?
Yes.
Okay. All right. That's kind of a surprise to me, but.
Well, I don't believe we're in one, but
right.
price action has to confirm, I think. And you made a good argument with the PMO, but I would point out that the PMO went negative back in 2015 when we sideways consolidated in a correction. So it's not 100% guarantee. And I think we're consolidating. I haven't seen any evidence yet that that this is a bear market. I still believe that it's correction. If we go down, we take out those February lows on the S&P 500. To me, there's nothing more significant than price confirmation. So if we take those lows out, then I think we got some real problems in the market. But I believe they're going to hold.
Yeah, and if we do get down there, Tom, that's going to activate a rising wedge, and that pattern is a bearish pattern. So that's why I'm watching those wedges pretty closely as well.
All right, Julius, you're up now. What is your statement, or what do you want to talk about?
Right. Well, my statement is that, because I was going to talk about small caps and everybody who's reading today's DITC, but I know you want to talk about small caps, so I'm not stealing your thunder. So I'm taking another angle. And my statement is that the relationship between staples and discretionary is signaling a couple of months of weakness ahead. And the chart that I have up here on the left-hand side is the ratio between discretionary and staples. And on the right-hand side, you see those two plotted on the RRG, isolated without the rest of the sectors. The left-hand chart, that ratio chart, is a chart that I use a lot for basically a call risk on, risk off. And the way I look at it right now, or for a while already, is that we have completed an important double top here that happened outside of the rising channel. So it behaved itself perfectly. It broke out, which was positive. We came back. Old resistance became support. Again, the top was tested, not broken, the first negative, and then we basically break a double support. We break that intermediate low here that completes the double top, and we come back into a rising channel. And if a market comes back into a rising channel, and this is something I've seen happening time and time again, very, very often, that market will go back to the lower boundary of that channel. So that means that this ratio, which means risk on when it's going up and risk off when it's going down, has room all the way down to the levels that we saw back in 04, 05, 06, and then again in 15, 16 where we broke out. So that will come back here. By the time it happens, that horizontal level will intersect with that rising support line. And when we get new low in place here with some sort of a bottom formation, and that'll probably be well inside 2019, that's when I think the market will become more bullish again. I'll be looking for buy signals.
All right. So you're arguing that the consumer discretionary, because we are weakening that consumer discretionary versus staples, you're looking for further deterioration in that relationship.
Yes.
So that's going to delay any kind of a buy signal for you in the market.
Yes. Yes.
Okay. Erin, what do you think?
All right. I think it's pretty obvious. I totally agree. That is one thing that is really bothering me, and something my dad and I talked about. We talked about the FANG stocks, really suffering lately, but we also talked about sector rotation, and we're very concerned about which sectors are leading right now. And, Julius, you made a great argument right now, and I think even in your presentation, when we were looking at those sectors on the RRG, that there are some serious problems if we're going to continue to see this strength in those defensive sectors. And it's so far, we are.
Yep.
So.
All right. I'm going to agree with you. I'm buying this, Julius. Even though I'm bullish, I do think that I think that those ratios, those relative ratios, like the one you're showing there, the XLY, XLP, I think they trade a lot like a stock. I think that you have outperformance for a period of time, even in bull markets. And I think you'll get those pullbacks in bull markets as well. So I believe, and I've said before, we had such a huge run up in that ratio, the XLY versus the XLP, that if you look back throughout this entire bull market, you've seen periods. You could go back really to the latter part of 2015, early 2016.
Oh yeah,
that big drop down.
exactly.
But essentially, we have these higher highs and higher lows that continue to go in since that bottom year back there in 2000.
This one and this one and this one. So the uptrend in the ratio is still intact, but this is such a long-term time frame that we're in trouble for a couple of months at least.
Yeah, I would say I would agree with that. I think we're in trouble in that there will be pockets of weakness. I think stocks like Amazon, I mean, Amazon obviously is a big part of that XLY, and we've got some technical weakness going on there. I think that may take some time to play out. But the flip side of it was when Amazon was going up through the roof, you can see that huge run up back in early part of 2018 because of the performance of Amazon and some of the other highly weighted individual stocks in the XLY. So I think you're right. I think we're going to see more rotation. I don't think that rotation necessarily is a bad thing as long as that overall channel that you're showing there on the left side stays intact.
Yeah.
Okay. My turn.
Yes.
Take it away.
We're waiting.
I'm in trouble.
Bated breath.
Yeah, both of you all got 100% agrees. I already know I'm getting 100% disagree. So I'm going with it anyway. I like to stir the pot a little bit. Okay, so I am going to say that from here on out, we're going to see outperformance in small caps. I'm not saying necessarily small caps are going higher from here. I just believe we're going to begin to see outperformance. I agree with what Fed Chairman Jerome Powell said the other day, that our domestic economy is very strong, and that even though we are seeing some issues globally, that the U.S. economy is strong, which I think will favor the small caps going forward. Here is a chart of this is a long-term chart showing higher highs, higher lows. And I think what we have seen is simply something that's inevitable. We need to see pullbacks from time to time. The market really is not healthy if it just continues going up, up, and up. We saw this back in 2013, and you can see the sideways consolidation that played out for a while. I think it's good that 2018 is turning into be more of sideways consolidation. So the first point I have here is that the Russell 2000 is still in an uptrend. We have not lost the February low, which I think is the first really key area of support. And then I'm going to go with a chart that I like to show from time to time, which is this 10-year Treasury yield, U.S. versus Germany, which continues to be in an uptrend, which typically leads to a rising dollar. We've seen that throughout. There's a pretty strong positive correlation between the dollar and the direction of U.S. Treasury yields versus Germany. And then finally, what we normally see is when the dollar is going through these periods of intense buying pressure, which I think we are in right now, typically we see the small caps outperform. Now, that has not been the case over the past few months, but we are hitting a major area, 2-year relative support level on the Russell 2000 relative to the S&P 500. So I think this is an area where it just makes sense. We've got the Russell 2000 still in an uptrend, not far from key support from February. We've got the dollar, I think, clearly in an uptrend, which should benefit small caps. The rising dollar eats into profits of multinational companies, has no such effect on companies that operate mostly domestically. And then the final thing I want to show you is if we pull up the seasonality on the Russell 2000 first, and we're going to drag this back the last 20 years, and you'll see that the month of December, actually November and December, are easily the two best months of the year for the Russell 2000 over the last 20 years. And if we compare the Russell 2000 to the S&P 500 over this same period, you will see the relative outperformance is really off the charts for small caps in November and December. So based on all of that, my point is that from this point through December 31st, small caps outperform the benchmark S&P 500. Are you two buying this?
So it's going to outperform. I mean, I could buy that, but I think there's still a huge amount of weakness. I showed you all those monthly charts. I happened to peek at my monthly chart for IWM, the Russell 2000 ETF, And I got a monthly PMO sell signal at the end of October. It came in and it was final. And, we've just now executed another rising wedge. I think there's still some possibility here if we can continue to move off of the bounce that we got last month. But I don't know. I think the downward pressure by large caps might, hurt the small caps despite a rising dollar.
Okay. So I'm gonna conclude for you that you are not buying it, or you are.
Yeah, I have to. I mean, the way you worded it, I do buy it, and that I think they will perform better than the larger caps. But I don't think they're going to. When you say better, I just think they're not going to go down as much. So.
Well, you agree with me then?
Yeah, I suppose I do on that level.
But I wanted to take a little different angle because we already just talked about bear market. So I just want to say small caps outperform. And so you're buying it. Julius,
I'll buy that.
Well, I think I gave you the answer already this morning when you were asleep in the DITC. I think that small caps are leading the market lower, and I'm absolutely not buying this. I think that they will go much more underperformance. And the chart that you showed where you had the Russell 2000 in the ratio, I think that's actually, I think you had the Russell versus the S&P 500.
Yes, down here at the bottom.
Yes, that green line, that's going to give way.
Okay. Fair enough.
Don't worry about it. Might happen tomorrow.
All right. Awesome. Well, it was fun. It was a fun segment. There's your summary. We didn't do the buying it or not buying it, but Erin's statement that we're not out of the woods yet. Julius and I both agree with that. My statement that small caps will outperform kind of got a roundabout support from Erin, but I got nothing from Julius. Julius is going opposite me, which is fine.
Yeah, absolutely.
And then Julius talking about consumer discretionary versus consumer staples and the fact that we are likely to see a continuing pullback on a relative basis in consumer discretionary, and that could lead to some struggles for a period of time. I think both Erin and I agree with that.
You got it.
Woo! Great show.
What a show. Always fun. These segments are fun where we can have a little friendly debate on what's going on because everybody looks at the market differently. You've got your RRG things going, Julius, which I think are great. Erin likes to follow her decision point, which I think is great. And I'm all over the place.
Yes, you are.
You're a troublemaker.
I know.
No, I mean, you still have an analysis process that you follow. So, I mean, I think you're still,
I just have a lot of things that I try to process. And what I find myself, especially being on Market Watchers Live and having, Bruce Fraser come on talking about the Wyckoff, and Julius, you come on with the RRG. And of course, Arthur has done so much work. He's a professor of the market in himself. And Greg, of course, with his commodity look and everything. We just get so many different folks that come in here, and I find myself trying to take little pieces from everybody.
Well, that's the whole idea.
Yeah, that's
what makes it worthwhile.
Yeah. So I don't know exactly what I follow anymore. Anyway, Julius, it was fun having you on here again. You got to come back soon.
Yeah, third Thursday every month, man.
All right. I didn't even know that.
Yeah, I know, me either.
Great. Well, now I know. Always appreciate having you on here. It was a lot of fun.
Excellent.
And good debates there, Erin. Appreciate it. All right. Thanks, everybody, for joining us. Please remember to complete that survey as you exit. I know Julius would like to get some feedback on the RRGs. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. See you back here tomorrow. Happy trading.